Types of traders. Now there are many different kind of traders, and traders of derivative securities can be characterized by as such. There are hedgers, there are speculators, or there are arbitrageurs. So let's look at each of them. So the hedgers are interested in reducing, can we put this here, reducing risk. So for example, there's a situation where a company wants to reduce the risk of the future contract price, so they might do a forwards contract to buy the stocks in 3 months time, because the future is not known, so they want to reduce the risk. So they want to lock in the price today and they buy a futures contract, and they use that strategy to lock in the exchange rate in another currency. So that would be a hedger who would look to take the more certain approach for not worrying about what can happen in the future. For example, if the oil prices in 3 months are going to change, we don't know how much is going to change, so the hedger will say, okay, I will do a futures contract and make a contract to buy or sell the oil at a certain price in the future, thus reducing the risk of the unknown. The other kind of trader is a speculator. The speculators will take the risk and make the bet that the price will go up or down, and they will use the contract for speculation. So an investor who thinks that the sterling will increase in relative to US dollar can speculate by taking a long position in a forwards contract on sterling. A arbitrager is gonna someone who trades in more than one currency at the same time. The example to give is quite confusing and difficult, but most importantly, arbitrage involves making a trade, let's say in US dollars and the GBP at the same time. So for example, there's a stock which is traded in USA exchange and UK exchange. So what the arbitrager will do is buy at one side and sell at one side at different currencies. So let's say the arbitrager will buy 100 stocks at price of $172 in USA, and then this is going to be buy 100 stocks and sell 100 stocks at price of the stock price for the GBP at 100 pounds GBP. So when the time comes, the maturity time in UK, so what will happen is that the seller will sell the stocks in UK and buy the 100 stocks, thus only arbitraging the difference in the currency exchange. So if the currency rate is 1.75. So what's happening is that he has to pay $172 to buy 100 stocks and get $175 to sell 100 stocks, thus making the profit in between of 175 minus 172 times 100 stocks, giving him a net profit of 300. Now, this is a very good system here with arbitrageurs, but the problem with this is that the small investors, when I say small investor, it's somebody who trades less than say $100,000 in cash. It could be even be $1 million, because the bips are so small, and then there are transaction cost. It could be $5 to trade, and if you don't have a big size of a lot, you're not gonna make any profit. So this option is mainly for a very big companies to take, and this is something not for us. So we actually fit into the speculator type of trader or the hedgers.